Right, welcome back, guys. In this section we are going to be talking about market structure. I'm gonna give you a brief introduction to market structure. So we're going to be talking about uptrends, that is when market is moving to the upside, or in other terms we call that bullish. Then we've got downtrends, that is market moving to the downside, what we refer to as bearish. Then we've got sideways. Sideways is what we call a consolidating market which is in a range. Then we are also going to talk a bit about the swings. These are the swing high and the swing lows. So the same as it is with the different trading styles gaining and losing popularity over time, people like to use buzzwords like liquidity, market structure, without actually knowing what it means or what they're talking about. In this section I'll be focusing on widely used terminology, market structure. In its core, it's very simple and correlates with the term trend. But as it is with everything, it's easy to understand the core principles but hard to master the small differences in a live market. The time frame does not matter. There can be trends within trends within trends. The higher the time frame, the better and the stronger the trend, obviously, but the basic characteristics of a trend can be applied on any time frame. So let's start with the basics, right? So what is market structure? Market structure consists of three different types of trends. Number one, we've got uptrends, we've got downtrends, we've got sideways, also known as consolidation or a ranging trend. Then we've got the parabolic. Each subsequent trend and even the trendless sideways movement have specific characteristics. To understand market structure and ultimately what a break in market structure means and looks like, first we have to understand what the specific signs of each trend are. So firstly, we're gonna talk about an uptrend. We're gonna see what consists an uptrend. An uptrend consists of higher lows and higher highs. So when you open a chart, clearly this is a theoretical presentation, and on a chart it doesn't look like the way we are presenting it now, but it's for you to get a clear idea of what an uptrend looks like. So when you open a chart, market will be moving in an uptrend, or market will be bullish, and it will be forming what we call higher highs and higher lows as it moves. As you can see, each and every higher high is broken when market is in an uptrend, but every higher low is not broken. Remember, when we talk about in the section of support and resistance, we talked about resistance which is broken or support which is broken. You can clearly see these higher lows, 1, 2, 3, they haven't been broken to the downside. That is a clear signal for you to say that, okay, market is in an uptrend, and each and every higher high, we've got one here and it was broken here, formed another new higher high, it was broken here, formed another new higher high which was broken here. So this is a representation of a uptrend. Then we've got a downtrend. A downtrend's characteristics are lower lows and lower highs. So that's the opposite now of an uptrend. So we will have market moving in a downtrend, or a market will be bearish, and it will be forming lower highs, lower lows, lower highs, lower lows as it goes. And on a downtrend, you can see that every lower low is broken to the downside. This lower low was broken here, we formed a new lower low, market formed a new lower high, it broke the previous lower low to form a new lower low, formed a new lower high and broke it. And you can see price does not break the previous lower high. This now to you means market is in a downtrend, or market is bearish. Then we've got a consolidation, or a sideways. A consolidating market does neither of the above mentioned until supply and demand, or support and resistance, are out of balance and price breaks out. Take note, a breakout can occur either to the upside or to the downside, depending on where the price is in correlation to the overall market. So a consolidation market will have two, basically supply and demand zone, or a support and a resistance key level, and market will rally to your resistance and it drops to your support, rallies again to your resistance, drops to the support, rallies again to the resistance and drops to support. This is what we call a consolidation. Market is consolidating, or market is ranging, right? But take note, it will either break in either direction, whether it's the downside or to the upside. In this case, I have a representation of an upside market breakout, and then we've got a representation of a downside market breakout. Finally, we've got what we call a parabolic advance. This is a very special type of trend, the parabolic advance. People might believe a parabolic move is only limited to crypto, but it is not. Throughout every asset class, you can see some sort of parabolic advance on all time frames, even on intraday. A parabolic advance does not, or at least gives you little to no chance to get on board on a pullback, while price moves fast and strongly upward, and usually consists of subsequent bullish candles with little to no retracement at all, and is driven purely by greed. A break of that parabola leads to a break in market structure, and the speculative driven fast ascent comes to a halt. So this type of trend hardly give you any chance to hop in on board so that you can trade along the trend. Now, what to look out for? Things you have to ask yourself when looking at a chart. What is the preceding trend? Is it an uptrend? Is it a downtrend? Is it a consolidating market? Is it a parabolic? Where is price? Is it at support or resistance? Or is it at a supply or a demand zone? What is the overall higher time frame trend? This implies to when you look at a monthly, a weekly, and a daily time frame. Is market bullish? Is market in an uptrend? Or is market bearish? Is market in a downtrend? This is very important to ask yourself when you open a chart. It's very important to be aware of the following. Consolidations can take place at bottoms and at tops. They are not a specific sign of a bottom or a top formation. What do I mean by consolidation taking place at bottoms or tops? Like at a support zone, you can get a consolidating market. or you can get a consolidating market at a resistance zone. Now we've established a basic understanding of what trends can look like and what they consist of. It's time to move one step forward. The swings. There are two types of swings. One, we've got the swing high and we've got the swing low. On the illustration below, you can clearly see we've got here swing low, swing high, swing high, swing low, swing low. So the red marked lows, those are your swing lows. The blue marked zones, those are your swing highs. You must be in a position to identify a structure like this and be in a position to identify, okay, this is a swing low, this is a swing high. So what is a swing high? Swing high is a failure to close above a certain price level and hence a sign of exhaustion or sign of overbought. In this case, bulls exhaustion to push price further high. It's important to keep in mind swing highs take place at significant levels, which you must find on the left of the chart. In all situations, price fails to close above specific level and therefore getting rejected and leading to a breakdown. You can see here we had price form the first swing high, then it broke above, formed another swing high, and then it couldn't continue to the upside, formed another swing high. Then we've got the swing low. The same thing applies to a swing low, but vice versa, whereas bears fail to push price further lower and subsequently bulls take control. It's important to keep in mind swing lows take place at significant levels, which you must find on the left of the chart. And the significant levels I'm talking about can either be a demand zone or a support zone. Why levels to the left are very important? Because these are the places where a break in market structure can occur. If a low or a high has been violated by a candle close below or above, depending on the situation, it implies a shift or a continuation of the ongoing trend. Now you can see why it's important to understand the basic characteristics of a trend. Higher high, higher low, lower low, lower highs. It's very important. Higher lows in an overall downtrend mean nothing if price fails to accomplish another higher high. Market structure break. In order to understand what a break in market structure looks like, we have to understand first what an engulfing of a level looks like and what it really means. There are two types of engulfing. Number one, we've got the bullish engulfing and we've got the bearish engulfing. So what is a bullish engulfing? Bullish engulfing is when the body of an up candle, that is a bullish candle, completely engulfs either the body of its prior candle or a certain demand or support level. That is bullish engulfing. So I'm just going to illustrate here theoretically what it looks like. So we will have a down candle, that's a bearish candle. By now you should know that. Then we get a big bodied bullish candle that pushes to the upside. What you need to take note now here with these two candle formation, firstly, take note of the close of the bullish candle. It has to close above the previous candle's opening price, meaning the previous bearish candle's opening price. The bullish candle engulfs the previous candle completely. You see, the body of the bullish candle must completely engulf the previous bearish candle. Now, what is bearish engulfing? This is when the body of a down candle, it's now the opposite of bullish engulfing. In this case, it will be a bearish candle, completely engulfs either the body of its prior candle or a certain supply level or a resistance level. So we have market moving in an uptrend, then the last up candle, which is bullish, then we have a big bodied bearish candle. Take note of the close. It should close below the previous candle's opening price, and the bearish candle engulfs the previous candle completely. As we now have established a basic understanding of what engulfing means, we can now move forward onto this section's final topic, the break in market structure. Here is a very simplistic and theoretical approach to depict a violation of a trend and hence leading into a break in market structure at the top of an uptrend. That is, when we say a break in market structure, it means if we're in an uptrend, it means the market is broken now. It's going to start moving to the downside. So we have market moving in an uptrend. Right, take note where the red circle is. Market has been forming higher highs, higher low, higher high. You see, higher high, higher low, higher high, higher low. But prior to this now, can you see we had a lower high forming, meaning this higher high wasn't broken, and we had a lower low. This now is what we call a break in market structure, because now the trend is now starting lower highs, lower low, lower highs, lower low, lower highs, lower low as price moves. So that circled area is where the break in market structure occurs, meaning the uptrend has come to an end. The buyers are exhausted. So now here's a representation of a break in market structure at the bottom of a downtrend. Same applies. We had market moving to the downside, lower highs, lower low, lower highs, lower low, but this lower high got violated here and we had a new higher high. Then we had a higher low, market broke above, formed a new higher high. In the end, do you understand why it is important to keep an eye on the trend? Because the trend is your friend until it isn't. Use the trend to your advantage. There is money to be made both ways, and you can easily spot the shift of a trend and hence change your directional bias quicker. This way, if you pay attention to what the market is telling you. Thank you for getting this far, and I hope you found some value in this section. Remember to backtest any approach first by paper trading or demo trading. Thank you, and I'll see you in the next session.